What's your latest thought on whether a full deal with the EU is likely on Brexit?
I think it's 95% certain. I think we're going to have a very soft Brexit, as I've thought all the way along. And I think that Brexit, in a way, is a distraction from the deeper problems in the Eurozone, and particularly in Italy, which is yet to really manifest itself in a volcanic way, but it will.
Let's come back to Europe, the rest of Europe in a second. The shape of the deal, likely to be soft, likely to be struck. Would that still give the pound a rally from where we are at the moment once it is, ratified, if you will?
Yeah, the pound has risen quite a lot actually against the euro, and it's fallen against the dollar because the dollar has been in the ascendancy generally. I think because the dollar, in my view, is peaking, that we will see the pound go back to 135 or 140 in the relatively near future. It's undervalued at the moment, and the British economy, despite all the naysayers and despite the bad headlines, is doing quite well. It's one of the fastest growing economies in Europe at the moment, if not the fastest major economy. So I'm quite optimistic about the pound.
Let's focus, therefore, on continental Europe. Clearly, you're not as optimistic, which we should say is a view you've always maintained. Italy is the red flag for you at the moment.
Yeah, I mean, there's no way that the ECB can contain the Italian situation if it carries on as it is. And as we know, if the BTPs get above 4% on yield, and they're not that far away from it, then Italy has really no option but to leave the euro and to take some drastic action. And the omens are quite good for the Italians. And of course, it's not going to be announced in advance that they will leave the euro. But leave the euro, I think they will do, and it will be in their interest to do so.
So that's quite a stark belief in where this situation goes. That's probably not priced into markets. Does changing in leadership in Germany, or potential change at the Chancellery, increase the chance of that people won't want to provide a backstop in the way that they had to Greece, or not? Is that not really the factor here?
No, I think it's a major factor. I think if Merkel goes, and the omens are she's going to go very quickly, then the alternatives within her party are much more Eurosceptic and less likely to support an Italian bailout or debt forgiveness, which is what the Italians actually need and want. So in my opinion, we will have this crisis in Europe, and actually it will present fantastic buying opportunities because the European markets are relatively cheap. The euro itself will fragment, and there'll be great buying opportunities. And that's the time really to focus on Europe and to drill down into what's good and what's bad in Europe and try and pick the eye's teeth out of it.
Let's bring back this discussion to the US markets. When we talk about the Eurozone crisis 2010 to 12 or the Brexit vote initially in 2016, those issues weighed significantly on US equities because of the fear of contagion, A, across all of Europe, but B, then onto the global economy. Do you think that's going to happen again, and this is something that US equity investors should be focused on? Yeah,
I think so, and you'll have a short, sharp correction if Europe blows up, because obviously the Brexit vote was as nothing compared to what would happen if Italy left the Eurozone, which I think is a very high likelihood, by the way, in the next couple of years, if not before. And so it's going to result in a sharp shock. The market's already quite overpriced in most areas in the United States, and so I would just hold cash. And that cash you might consider putting into Japanese yen, you might consider putting it into British pounds, because I think the dollar is peaking.
And if we do get that shakeout in Europe, what are the main areas that you do think are undervalued that will be long-term survivors, if you will?
I think that the consumer stocks in Europe look very cheap, and the consumer stocks in the UK look particularly cheap at the moment, particularly if you think there's going to be a Brexit deal. But I would literally put a buy order in at 10, 15, 20% below current levels, because they will get there. We're going to have a bit of a crisis, a fairly major crisis when Italy leaves. And even if Italy doesn't leave, and I'm wrong on that, all the stuff surrounding the Italian problems is not going away in a hurry. So I would go for those consumer staple stocks, which are now becoming quite cheap. The drug companies are looking cheap. And even the banks, in certain instances, post an Italian crisis, would look very cheap indeed. And the UK banks, Lloyds in particular, are well-founded and cheap at the moment.
US financials at the moment, relative to the rest of the market, they look cheap, but you seem to be fairly bearish just generally in the US.
Well, I mean, the US financials have had, generally speaking, a very good run since in the last 5 years or so, and they sell at a premium to book value that's quite substantial compared to, for instance, Lloyds or HSBC. So I concentrate my attention on the dividend-yielding companies like Lloyds or HSBC and focus on them. They're very liquid stocks, and I think they're ones that you can buy and hold with great confidence over the next 10 years or so.